I'm often asked if we are in a housing bubble, and as such, are we heading towards a housing market crash? Mostly people are asking this just because home values have increased dramatically over the last couple of years. And then pair that with the economic woes that we're facing, such as the pending recession that might come upon us before too long, if it hasn't started already. So I have some good news. If you look at the data, the upward trends that we've seen in the real estate market over time have been consistent even in the face of significant economic problems, such as recessions over the years. And so in this episode, we're going to take a look at some data that supports that and shows you what we can expect looking forward into the future. So stay tuned. Hi, everyone. Welcome to Real Estate on the Front Range, my weekly podcast where I cover all things real estate here on the Front Range of Northern Colorado. Join me every week to get market updates, tips, and information on relevant topics to make sure that you're fully informed before you buy or sell your next home. This is Sean Gilliam, your host, and I look forward to you joining me on Spotify, Google, Apple, or whatever your favorite podcast app is for the latest episodes. Welcome back to another episode of Real Estate on the Front Range. To continue our discussion, many people are concerned that we're heading towards a housing market crash. And this is predominantly so because of the looming recession, not to mention the other issues that are going on around our world. The war in Ukraine, disease, all those kinds of things, and also inflation, of course. However, it's important to understand that even if we head into a recession, that does not equal a housing crisis. When you look around you, all the experts are stating that we're headed towards a recession. However, even if that's true, even if we have this economic slowdown, it doesn't mean homes will lose value. The National Bureau of Economic Research defines a recession as a recession is a significant decline in economic activity spread across the economy, normally visible in production, employment, and other indicators. A recession begins when the economy reaches a peak of economic activity and ends when the economy reaches its trough. Between trough and peak, the economy is in an expansion. To help show that home prices don't fall every time there's a recession, take a look at the historical data. There have been 6 recessions in this country over the past 4 decades. Going all the way back to the 1980s, home prices appreciated 4 times and depreciated only 2 times. So historically, there's proof that when the economy slows down, it doesn't mean home values will fall or depreciate. The first occasion on the graph when home values depreciated was in the early 1990s when home prices dropped by less than 2%. It happened again during the housing crisis in 2008 when home values declined by almost 20%. Most people vividly remember the housing crisis in 2008 and think if we were to fall into a recession that we'd repeat what happened then. But this housing market isn't a bubble that's about to burst. The fundamentals are very different today than they were in 2008, so we shouldn't assume we're heading down the same path. To say that the fundamentals are very different is basically saying that lending standards are tighter and loans are held by borrowers that are more financially stable and able to pay their bills. Let's take a look at some data that supports this. First, we have the Mortgage Credit Availability Index, and this index represents how easy it is to get a mortgage. The higher the index, the more available mortgage credit is, or to put it simply, the easier it is to get a mortgage. Leading up to the housing crisis in 2008, almost anyone could get a mortgage, especially those that really couldn't afford it. When these borrowers inevitably defaulted on their loans, the housing crisis began. Conversely, the lower the index is, the harder it is to take out a mortgage due to tighter guidelines to qualify for a loan. Those that do qualify for a mortgage with these tighter guidelines are generally solid financially and are able to make consistent payments over time. As the graph shows, the index stood at about 400 in 2004. Mortgage credit became more available as the housing market heated up, and then the index passed 850 in 2006. When the real estate market crashed, so did the MCAI as mortgage money became almost impossible to secure. Thankfully, lending standards have eased somewhat since then, but the index is still low. In April, the index was at 121, which is about 1/7 of what it was in 2006. To further illustrate this, the next graph shows the amount of money that has been loaned to those with credit scores below 620. By comparison, a very small amount of loans out there are held by those with low credit scores. Many have low credit scores due to not making payments on time, defaulting on loans, or maxing out their available credit. Investors consider borrowers with low credit scores a high risk, and as such, there aren't many loans available to them. I should point out that having a low credit score doesn't necessarily make you an unfit borrower. Many have received a lower credit score due to circumstances beyond their control. However, they are responsible adults and working on building up their credit scores by making good on their promises to repay the debts. In 2008, one of the main things that caused home values to decrease was the amount of foreclosures and short sales that hit the market. These are typically sold below market value, and the more you have in any local market, the more property values go down across the board. To see what caused this, check out the movie The Big Short. It gives a good explanation dramatically of what caused the housing crisis in 2008. However, it's important to note that things are different now. Even with the recession in 2020 and the economic impact of COVID 19, home values increased and the amount of foreclosures was relatively low and steadily decreasing. In fact, the number of foreclosures has steadily decreased since 2010. Looking forward, not only are we not expecting a housing market crash, but we can expect to see home values continue to increase. In all likelihood, the pressure of inflation and the prospect of another recession will likely cause home price appreciation to decrease in intensity. Looking at this graph, we are likely to see home values go up at a slower rate year over year. This is still appreciation, not a loss in value. Historically, home values have continued to rise since World War II. The only blip was due to the mortgage crisis already mentioned in 2008. In all likelihood, this graph will start to plateau with a less sharp upward trend over time. I hope this episode was helpful and encouraging in light of all that we have going on in the world around us and our personal lives. The housing market should remain stable and continue to appreciate in value. We're going to see some slight softening and moving towards a more balanced market, but I think that's going to be good for everybody involved. If you have any questions, feel free to get in touch. And of course, if you need help with buying or selling a home, I have some useful information that I can give to you for free, my home buying and selling guides, and would be glad to consult with you and see or make sure you get yourself in the best position moving forward. I look forward to talking to you soon. Take care.